Hello, everyone. Good morning, good afternoon, good evening. My name is Hoda Mehr. I'm founder and CEO of Stock Card, and this is a part of our 100 bagger stock research series that we've started a couple of weeks ago. And today we're going to talk about Tesla. Whether Tesla is going to be one of those 100 bagger stocks or not. And I know a lot of the folks on Twitter and on YouTube have been excited about this one because who doesn't love Tesla, or actually who doesn't hate Tesla? I don't know which camp you fall in, but some people hate it, some people love it, but we're all going to talk about Tesla. Okay, without further ado, let's jump in. Let me switch my screen and basically let's get started with Tesla. And basically just tell you a little bit about the company's background and why we've been talking about Tesla. So if we look at Tesla as a stock, it's already, since its IPO, it's already generated more than 100x in return. And so this is, I'm going to switch my screen here and then go to actual Tesla's stock card and make sure you guys see it. Maybe we can zoom it a little bit. But if you look at Tesla, Tesla's a stock, and if you go to its chart here, you see that if we put an all-time high return from when it IPO'd back in 2010 at a split adjusted price of $1.50, and today at a split adjusted of $216, it's already generated 135 times return. So Tesla has already been a 100x return, 100 bagger company. And the question now, the all-important question is, do we hold it, and do we think that it can generate another 100x in return? And at the end of the video, I will obviously go through the framework we usually use, the 7-part framework for evaluating 100 bagger stocks. But at the end of the video, I will talk about what should or what could happen, what is possible for Tesla in order for this company who's already generated 100x return, create another 100x return. By the way, if you're watching live, thank you for watching live, and please add your comments or your questions or chime in whenever you can, and I'll get to your questions or your comments at the beginning, or if you're watching at a later time, please add your comments again in the comment section, and we'll have a conversation about Tesla. All right, let's get started. For those of you who are not yet familiar with the framework we use for evaluating 100 bagger stocks, let me make this a little bit bigger. The 100 bagger framework, it's a framework I use from Christopher Meyer's book, 100 bagger stocks. And I've been improving it as I've learned from other investors. So this is an enhanced version of Chris Meyer's book. There's 7 factors to it. And we go through all these factors one by one and evaluate every company that we want to evaluate. So number one factor is a company's size. And right off the bat, I know you all guys know the companies that Tesla's market cap, it's already giant, right? At a 600 and almost $700 billion in market cap. That is number one reason that gives me a pause to think that Tesla can create another 100 bagger 100x return. It's because if it actually increases if it increases by 100x, it almost gets close to the global GDP as of right now. I actually, before the live stream started, I was researching what is the global GDP right now in the world, and that's about a $100 trillion, $96 trillion in global GDP. So if we take Tesla's $673 billion and multiply it by 100, we're going to get a $67 trillion in market cap, and that is almost difficult to imagine it's possible one company can get as big as that. So that is just by itself is just the number one reason when it comes to the framework, it gives us a pause. For Tesla, it's not going to get that number one criteria. But let's look at everything else. It doesn't. A company can become a 100 bagger, not necessarily meet all of the criteria, but it could actually meet a few of the criteria. I'm going to go through these three ones all together. So does it have consistent revenue? Does it have history of expanding its earnings? And does it generate free cash flow? These are all metrics or KPIs of a company that you could get from their financial statements if you know how to read financial statements. I'm going to use a stock card to get the summarized version of these financial statements or financial metrics. So number one on Tesla is, does it have a consistent revenue growth in order to become the 100 bagger? So when you look at Tesla's revenue based on 6 different analysis, it has strong growing revenue. Let's get a little bit of a detail. Last fiscal year in 2021, the company generated $53 billion in annual revenue and a quarterly of $21 billion. And when we look at its basically growth rate on a quarterly basis, Tesla has been growing 26% per quarter. On an annual basis, it's been growing 70% per year. On a compounded annual growth rate on a 3-year basis, Tesla has been growing at 47%. So a big thumbs up in terms of revenue growth because Tesla is now at that point of its operation that it's found a way to deliver more and more vehicles, and that's obviously generating higher and higher returns. The second criteria from a financial statement we want to look at is that whether the Tesla has a growing earnings power. And if you've been with me in the past 100 Bagger series research, you know that there's 2 ways to look at the earnings power. One is obviously we want to look at the company's profitability, whether the company is profitable or not. So Tesla generated last year about $13 billion, almost $14 billion in annual profit, annual gross profit. And if I scroll down all the way to its basically net income or net profit, bottom of the barrel, at the end of the income statement, it basically generated $5.5 billion annual profit and $3.2 billion quarterly profit. If you look at its growth rate, it's not as consistent, but it's been able to grow its profit year after year and quarter after quarter. So definitely the company gets thumbs up on its profitability. I did remember when about 2 years ago, a lot of analysts were worried about whether Tesla's profit is actually real. There were reports in the past about Tesla having this dirty little secret, as financial analysts were calling it, which was a concern for me because before 2 years ago, they were saying that most of the Tesla's profit, EBITDA or earnings before interest, tax, and depreciation, amortization, bottom of the barrel, is coming from the regulatory credits that the company receives. So that was a big concern for a lot of investors. So I wanted to validate that before give the thumbs up to Tesla in terms of its profitability. Is its profitability still related to its regulatory credit? And I pulled the company's basically latest quarterly earnings report, and I wanted to see how much of its profit is related to the regulatory credits, right? So this is, should I make this a little bit bigger for you guys? Let's just make it a little bit bigger. This is the latest quarterly earnings Q3 of 2022. And basically I saw here that the regulatory credit is about 286 in millions. And if you look at the company's operating, basically adjusted EBITDA, which is sort of the bottom of the barrel, almost a $5 billion in adjusted EBITDA. So compare this to this this regulatory credit. That concern that a lot of analysts had 2 years ago about Tesla's profitability, it's not relevant anymore. It's not a little dirty secret anymore for Tesla. Tesla's profitability is real and it's actually generating good profit. So that's a good thumbs up for its profitability. But when it comes to companies' earnings power, if we go back to the framework, of a 100-bagger company. The third one is about whether it has a history of expanding its earnings power. So there's two. If a company is profitable, obviously we want to look at its profitability, but we also want to look at its ROE, return on earnings, right? Every return on equities. So every dollar that the company generates in earnings compared to every single dollar of equity on its balance sheet for its stakeholder. Typically in history, in the last decade or last century or so, every company that has at least 100x in return has found a way to consistently grow its return on equity, its ROE. A very good example of that is, for example, MasterCard. If you ever look at MasterCard return on equity, you'll see that how it has been consistently growing as its return on equity. So it's a really good indicator for a company's ability to expand its earnings, right? So I do want to go to the company's ROE, Tesla's ROE, and take a look at its ROE. It's under management effectiveness segment on its stock card. And I'll scroll down to ROE. So it is not as consistent. Last fiscal quarter, 34%, which is a really good number. But 2 fiscal quarters ago, it's almost negligible, right? On an annual basis as well, if you look at it, last fiscal year 21, 2 fiscal years ago about 5, and 3 fiscal years ago about -14. So that's a question mark, right? Yes, it is profitable, but it has and it's moving. Its return on equity is moving towards the right direction, but it's something that we would want to be watchful of it. Quickly, let's go look at the free cash flow. Does the company generate free cash flow? And free cash flow, it's such an important aspect of a company that can generate 100x in return. It's because free cash flow is, as regardless whether the company is profitable or not, is the money left in the bank that the company can use to reinvest in its operation and grow its operation. And God knows, because Tesla needs a lot capital, right? For creation, for developments of its gigafactory, for delivering all the product it needs to deliver. It's a hardware company, it's a manufacturing company. It needs way more capex, capital expenditure, than anybody would want to accept. So I do want to look at basically its free cash flow. And what before this call, I was actually checking it, and free cash flow is pretty strong and solid for Tesla. Generates about $3 billion in free cash flow on last quarter. It hasn't been as consistent as one would hope on a quarter over quarter. But you see, last 3 fiscal years ago, about almost $1 billion, and then almost $3 billion, and now $3.5 billion in a fiscal year. So it is moving towards direction. What the company's ROE told us, what the company's free cash flow told us, is that all the criticism that exists for Tesla maybe 5 years ago, that it's not profitable, it's really money grab, it doesn't grow, it's all gone at this point. The company has found its business model to become profitable, it generates free cash flow. I wouldn't really just give a big thumbs up here though, because we know the company has significant amount of liabilities. The company needs a lot of capital. So it's a good sign that it generates free cash flow, but we also be mindful that it's a manufacturing company. We're down to the last 3 criteria for evaluating a company like Tesla for its ability to generate 100x. And this one, the 5th one, is, do we have a chance to buy the company at a lower multiple? And this is a controversial one, right? Because a lot of folks, obviously, there's this whole argument about whether Tesla is way overvalued or whether it's undervalued compared to its future. If you look at Kathy Wood and her team, and basically what they've done in their analysis around the company's valuation, they tell you it's extremely undervalued. But if you look at historical metrics in terms of price to equity, price to sales ratio, there's a totally different story. So first, let's look at those metrics that we typically use when it comes to valuation, and give me a few minutes, because at the end of finishing the 7-part criteria framework, I'll get into the detail of valuation targets for someone like ARK, so that we can contrast it with what the numbers are telling us right now. But if you go to the company's valuation section on the stock card to get some of the typical metrics that we would want to look at when it comes to valuation, we'll see that the company is based on its historical data is overvalued. Let's look at what does it mean. It's price to earnings ratio of 70x. So whatever you want to think about valuation, there needs to be a significant reason for this sort of valuation. This is extremely expensive. And I want to go to the company's price to sales ratio of 10. So investors are pricing in that Tesla's revenue can be 10 times bigger than what it is today. And that's how they're pricing it, even at this current price. So based on historical common valuation metrics, Tesla is extremely overvalued, and we can't really buy it as at a really good price. But again, put a pin on this point. I want to have a conversation about why these valuations may or may not be a real indicator of Tesla's valuation in the next decade or so, right? So put a pin on it. But for now, it's extremely overvalued from valuation point of view. We're down to the last two metrics or criteria we use in order to evaluate whether a company is a hunter bagger or not. And this one is about leadership, whether the company has skilled leadership in place in order to basically become that hunter bagger. So let's have a conversation about this eye to eye. I don't want to open up the can of worm of saying Elon Musk is a bad CEO or a good CEO. Everybody have their own perspective around what the company, what this CEO and this richest man on earth can do for the company. But think about what is the quality of a good leader. What are the capabilities? What are the skills of a good leader for a company? A good CEO needs to bring a vision that directs the company. A good CEO needs to find capital for growing the company, so raise money for growing the company. And a good CEO needs to hire the right people into the right role so that they can do their job well. And lastly, a good CEO or a leader for a hunter bagger stock is a person who has significant skin in the game. So evaluate Elon Musk against those four criteria, and he does get a thumbs up, regardless of what we think about his characteristics and what he does. So I would give him a thumbs up, and don't open that can of worms whether you hate him or like him. But from those four criteria of evaluating a leadership team, he has a skin in the game. He has found right people and put in the right places. That's why many of his businesses are growing. And he has found a way to fund the company. Whenever they run out of cash, he finds a way to bring in cash into the company, whether even if it's selling flamethrowers or not, right? Or selling perfumes or whatever he sell at a time, shorts, so things like that. So he has found a way to fund the company. And lastly, he brings vision. He gives this big, ginormous vision for the company and creates believers in the company. So regardless of what you think about his characteristics, he does get a very good big thumbs up for his ability to lead the company. And then the last one is the competitive moat. Whether Tesla has the competitive moat to basically grow. And this is basically where we may or may not agree on, because Tesla, if you think about it from technology point of view, if you think about from its ability to build EVs, obviously has significant amount of head start over other companies in the space. But from what we know in the EV space, electric vehicle space, Tesla certainly is not the only player, right? So if you're looking at Tesla as the only EV manufacturer, basically you think about its business only as an EV electric vehicle provider, it may not have any more that competitive advantage that we've been looking for, right? Obviously, it has very strong brand, so that's really good. It has almost like a cult-like followers. That's really good. But does it have technological leadership over every other? Maybe or maybe not. So I want to put everything together for you in order to just get a question, get an answer in terms of the Tesla's current business, current operation, and its ability to generate 100x. What we've been figured out is that it's just market cap is so big that it's difficult to assume it can get to 100x. It's been consistent revenue generating. In terms of earnings power, it's profitable. It does generate return on equity, but it's not. It's basically not consistent, right? It's moving towards the right direction, but it's just moving towards the right direction. Generating free cash flow, it does generate free cash flow, but we need to watch for its liability. It's a highly capital intensive business, so even if it generates tons of free cash flow, it still needs a significant amount of capital to grow. By no means, from historical point of view and current valuation metrics, the company is undervalued, so we don't have a chance to buy it at low multiples. And whether it has a skill leadership or not, I said I'm not going to open this can of worms. From my point of view, this leader has all the four check marks that a leader needs to meet in order to lead a company into prosperity. But you put your own check mark here, right, when you're doing your own evaluation. And from a competitive or mode point of view, it is the first mover in EV. It has a strong brand, so I give it a thumbs up. You can put your own valuation, your own metric here. But all in all, if we look at Tesla at this point with its current operation, and by looking at its operation, from my point of view, it cannot become another 100-bagger, right? And really, if you put everything here aside, and just look at its current market cap, becoming a 100x return from where it is, it means it becomes a almost like it becomes a giant $1 trillion, $71 trillion company, and that to me, it's very, very extreme. It may not happen. Tesla could still be a fantastic company in order to generate a return for you, but it may not be the next 100-bagger, or may not be able to repeat its 100-bagger status that it has already created for its investors since its IPO. But I do want to take a comment here from Jackie. Jackie says, competitive advantage or mode. It is basically, she's saying that Tesla has almost a monopoly in its business. Yes, Jackie, it did have, from what we know from EVs, about 5 years ago or 10 years ago, it had this head start in the business, right? In the business of generating, creating, manufacturing EVs. But currently, all car manufacturers out there are entering into this space. So its competitive advantage from a technology point of view in the EV space is not what it was 10 years ago, right? But I did give it a thumbs up because I think this has a strong brand, and I want to go through some of Tesla's aspiration when it comes to autonomous business, autonomous robo taxis and things like that. And that's where I think it's competitive and its lead in technology is basically there, right? But yeah, really, really good point. It's a competitive advantage in mode is around technology leadership. It's around brand. It's around lower cost of production if Tesla ever gets there. Those are some of the criteria that you would evaluate when you want to evaluate competitive advantage of a company. Thanks, Jackie, for that comments. Please jump in if you have any thoughts on the seven part framework of evaluating Tesla's ability to become the next 100-bagger stock or not, like Jackie did. But I want to get to the next part and kind of have a conversation around whether Tesla can become that 100-bagger stock or not. And this is super interesting because if we think about Tesla just be a electric vehicle, an EV manufacturer, even if it be able to basically produce all new cars sold globally, we buy as consumers 75 to 80 million units of cars per year. So if Tesla just produce all of that car that we need in the market every year, that's basically 46 times rich growth in its sales. So yes, if we know Tesla would never have 100% market share, so the car business doesn't have enough capacity for this company to 100x, right, grow. But Tesla is not only in the EV business, right? There's two other businesses that Tesla is getting involved in that might actually change the game for Tesla. One is it's wanted to go into robo taxis, so autonomous taxis, meaning that there might be a driver sitting in the driver's seat, but most of the work is being done by the actual machine, actual software, and at some point maybe that driver is not even there. That's sort of one business, and then the other one is the insurance business. So if you look at Tesla, I think Elon Musk is taking a page out of Berkshire Hathaway, Warren Buffett's page, and or school of thought, and basically introducing the insurance business for its cars and its vehicles, and that could become a cash generation place, or a way that Tesla can fund its very capital-heavy operations, and that would be very interesting because how we talked about free cash flow versus the amount of liability the company needs in order to grow its business, and amount of money it needs to grow this business. This insurance business that Tesla has just started can actually generate significant amount of cash for the company, just the same as how it has been generating, like Geico has been generating significant amount of cash at really, really low cost for Berkshire Hathaway, in order for Berkshire to be able to go and invest and grow their businesses all around the world. So those are the two possible ways that outside the current EV business, Tesla can actually become, it's almost become a different business, right? In order to become the next 100-bagger story. And then let's actually have a conversation about how is it actually is possible, right? What can autonomous business or the insurance business do for Tesla in order for it to become the next 100-bagger? So let's have these conversations first before we jump into the detail. In order for a company to become a 100-bagger, it needs to increase its earnings. Earnings is what's left, or increase its earnings power over the course of a decade, 2 decades. So put everything aside, valuation, put everything aside, market sentiment, craziness that happens in the market around Tesla, blips in sentiment up and down. In order for a company to become a 100-bagger, it needs to consistently improve its earnings, so generate more money for investors, so that's basically growing its earnings, or find a way to show to its stakeholders, its investors, that it has the potential to increase its earnings over the course of a year. So that's number one, that's top here. Or it needs to introduce businesses or get into line of businesses that have higher multiple, right? There's only two ways. There's only these two ways over the course of like a decade or 2 decades that you can increase your valuation to become a 100-bagger. Improve your earnings or show the potential that you can increase your earnings, or you can get into businesses that have higher multiples. Or you can get into the businesses that have higher multiples. So let's see if that's possible. Can Tesla grow its earnings with its current business by increasing higher efficiency, by improving efficiency through the automation of its factories, a la gigafactory manufacturing capacity? It is possible, but as we talked about it, there is not enough demand even in the market for electric vehicles, for vehicles in general, for Tesla to become the next 100-bagger, right? Even if you look at valuation models that a company like ARK Invest has created for Tesla, they don't believe increasing in the capacity of manufacturing of EVs, it's the most important factor for the company to improve its earnings or improve its price, right? So I'll get to that in a second. Even ARK Invest, when you read ARK Invest valuation models for Tesla, do not show that increasing the capacity of manufacturing more EVs is the reason for Tesla to be able to have higher valuation, higher stock price, right? So that's not possible. The insurance business could be a high earning business, but again, from what I've looked at, someone like ARK Investment, and look at the valuation models, which is one of the most comprehensive valuation models I've seen for different companies such as Tesla, they don't believe that the insurance business can generate that sort of earnings. The only business that can put Tesla to a higher valuation, basically a higher valuation level, right? Higher multiple for its valuation is the launch of its robotaxi and the autonomous cars platform. So this is significant. We don't have time to get to the detail of it, but I would put some links in the show notes, or ping me on the comment section if you want the link to some of the good content about Tesla technology when it comes to autonomous cars or autonomous robotaxis. It is basically estimated that it would create an $11 trillion of enterprise value globally, not just for Tesla. $11 trillion of enterprise value in the next couple of years. And someone like ARK Invest valuation model believes that 60% of the improvement or increase in Tesla's stock price is due to its technology leadership and its ability or its focus on autonomous cars, or head start it has in autonomous cars, in autonomous or robotaxis. So let's think about it. It's EV business. If it just stays in EV business, it may not become a 100-bagger. But if it manages to launch a robotaxi, if it manages to become that new platform for autonomous cars, that's an $11 trillion worth of enterprise value sitting out there for Tesla to grab. And that could be how and why Tesla become the next 100-bagger. So I want to put a note for myself and for you as well in your analysis, is that what we want to watch in order to evaluate whether Tesla can become the next 100-bagger or not is that, can Tesla actually launch its robotaxi? Elon Musk have promised 2023, I believe, for the launch of the first generation of robotaxis. Let's watch that. Let's monitor that. If they actually manage to launch that robotaxis, that could be how Tesla become the next 100-bagger stock. So with that, I want to give you the disclaimer. I own Tesla, not directly, but through my investment in ARK Invest, flagship product ETF. As you know, that's the biggest holding of one of the biggest holdings of the ARK Invest fund. And if we go to Tesla's, basically looking at which ETFs or funds own Tesla the most, is that we see basically ARK Invest should be somewhere around here, right? ARK Autonomous Technology, it's one of those funds that own Tesla, and RKK, it's 9% of ARK Innovation Fund. So that's it. Let's recap from based on the 7-factor framework of evaluating whether a company can become a 100-bagger or not. Tesla did not get most of the score. So if we only evaluate it from an EV point of view, it has not the ability to become the 100-bagger. But if we really look at where its earnings growth can come from, it's really coming from its possibility of launching robotaxis and autonomous cars, or become that de facto platform for autonomous cars. So that's a possibility, and that's something we would want to watch in the next year or so, and whether Tesla can actually launch that robotaxis. That could become Tesla's way to generate yet again another 100x in return for its shareholders. That's pretty much it. And I want to wrap up to tell you about a stock card. Just like Tesla, who aspires to become the next 100-bagger, we at a stock card are building the future of retail investing. We want to enable anyone who invests in the stock market to be able to become the best fund manager for their own assets. And that's our aspirations. We believe we're building the next 100-bagger story in fintech. So if you are a user or if you're new to StockCard, I highly recommend you to go check out a StockCard's fundraising page. Not only you can be a user of StockCard, but now you can be a stakeholder or stockholder of StockCard, our company. And we really hope to have you as users, but we also hope to have you as an investor in our 100-bagger story. Go to republic.com/StockCard and please join us as an investor. Hopefully we have you there. Is there any comments or questions from folks who are live? Before I wrap up, I'll be happy to answer a few questions if there are any. And if there's no more question, I will see you in the next 100-bagger story. Don't forget to click like and subscribe because I'll be doing a lot more of these 100-bagger stock research series, and hopefully you could get the notification and come join us live. Thank you very much for watching. I'll see you soon.